Hey everybody, it's Jack, and today I've got an amazing video for you all. For today's video, I'm going to be covering two great Canadian dividend stocks that I think are a buy for multiple reasons. One, they both offer monthly dividends, so you're going to be getting paid out on a monthly basis. And two, I think these stocks have room for growth. So not only are you going to be getting paid that monthly dividend, but you're also going to see potential for growth. So really, it's two perks for the price of one, and it's a double win in my books. Most dividend stocks pay out the dividend every 3 months on a quarterly basis, or even biannually, so twice a year, every 6 months. But these two stocks today, they pay out their dividends on a monthly basis. So what that's going to do is, if you're growing a small account, or any account for that matter, it's going to give you that monthly cash flow and that money coming into your account every single month from these two stocks. And really, that means that you can just take this money and reinvest it into more stocks every single month. So really, it keeps that ball rolling, and it's great for getting that passive monthly income. So for that reason, I think the monthly dividends can be a really appealing thing for any account. The two monthly dividend stocks that I'm going to feature in today's video is SmartCentres Real Estate Investment Trust, SmartCentres REIT, ticker symbol SRU-UN on the Toronto Stock Exchange, as well as TransAlta Renewables, RNW, on the TSX. Both of these companies offer great monthly dividends for passive income and also have great growth potential, in my opinion. So let's start with SmartCentres Real Estate Investment Trust, SmartCentres REIT, which has a whopping just over 7.5% dividend at the time of filming this video. You might be like, oh, whoa, that's so high. But don't worry, that's actually pretty standard when it comes to a REIT. If you're not familiar with what a REIT is, a real estate investment trust is a company that owns a portfolio of real estate properties. They can be anything from commercial buildings, like warehouses, to residential apartment buildings. SmartCentres is most known for their retail properties. And if you live in one of Canada's biggest cities, any of the big major cities, you've definitely been on one of SmartCentres' properties. So because they have this monthly cash flow coming in from the rent collected on all of their properties every month, they're able to offer this high dividend and sustain it. So just over 7.5% is a great dividend, and you're going to be paid part of this dividend monthly. So really, the cash flow coming in is going to be extremely good from this investment. If we take a look at SmartCentres' stock chart, they are currently trading around low $24 range. We can see that they are steadily staying around mid 30s to low $30 range for years until the pandemic hit, and they dropped to all-time lows of around $17 per share. We can see that since then, they've started to see a really nice recovery, and I'll get into the details of why this is happening. But the upside right now, if SmartCentres were able to get back to their pre-pandemic ways, would be a 33% upside to the share price. This is an awesome growth potential, as well as the monthly dividend of 7.5%. This one is really a no-brainer. We can also take a look and see that SmartCentres is backed by a super strong tenant base. Let's dive a little bit deeper into the tenant base of SmartCentres. So they actually have a 97.4% occupancy rate, which means almost none or barely any of their storefronts or buildings are going unused and not having rent collected. They also get 25% of their revenue from Walmart. So Walmart is their biggest client for sure. Some people might think that this is not a good thing, having 25% of your revenue coming from one source. I honestly don't mind this at all. I think this is actually a good thing because Walmart is a super strong company that I don't see going anywhere in the next year or two at least. So this is 25% revenue that you know is not going anywhere at all. Alongside Walmart, 50% of the rent that SmartCentres accumulates is from strong essential companies that are open during the pandemic and during lockdowns, and 60% of their tenants are these essential services that have remained open. And another key metric there at the bottom, 98% of revenue is from areas that will be first to reopen when lockdowns and everything goes back to normal. So this is key because SmartCentres is going to be able to bounce back fast. This chart shows how SmartCentres struggled early on in the early months of April and May, but how they have rebounded significantly well since then and are almost back up to 100% rent collections. This is great to see as the revenue is almost at pre-pandemic levels, but their share price, their stock price is still trading at a 33% discount. If we take a look at their financials, specifically their earnings, we can see that Q2 of 2020, they were in negative and by a lot. But in Q3, they rebounded perfectly to pre-pandemic levels, which is a great sign. Another extremely exciting reason to buy SmartCentres, besides the rebound in earnings and revenue, is the percentage held by insiders. So ownership and the executive team at SmartCentres owns about 10% of the company. And during the pandemic, they've actually been buying a ton more shares. Since the pandemic began, they've bought in over $12 million worth of shares. So they are seeing this as an opportunity to buy, and they are buying in bulk. The president and owner of SmartCentre has bought approximately $4 million worth of the 12. If the person running the company sees this as an amazing opportunity to buy, then so do I. The fact that the ownership team and the executives of SmartCentres are so heavily invested in the company and have been continuously adding shares at close to the current prices can really give a lot of faith to us as investors. The people who know the most about the company and its day-to-day operations, they're excited and are buying in, so we should too. They know the most and they're excited about this company and its growth potentials, not to mention the monthly dividend of just over 7.5%. This stock is a no-brainer for passive income and future growth. The second Canadian monthly dividend stock is TransAlta Renewables, ticker symbol RNW. This stock offers just under a 4.5% dividend. The company TransAlta Renewables is in the energy and utilities sector. It focuses on renewable energy and has operations such as wind, solar, hydro. If you've seen any of my previous videos, you know I'm super bullish on the renewables sector, and TransAlta Renewables fits perfectly into this space. TransAlta Renewables is currently trading around the $21.50 mark Canadian. They've seen great growth since the pandemic lows and are down around just over 10% from a month ago. Some of the reasons why TransAlta Renewables is a great buy is first that they're very diverse. They have over 47 facilities across Canada, the United States, and Australia. Not to mention that their monthly dividend is as safe as could possibly be. The average contract life for their power generating contracts is roughly 12 years in length. So their dividend is not going anywhere. These long-term contracts will make sure that their cash flow remains constant. TransAlta's monthly dividend of just under 4.5% is extremely safe. It's perfect for passive income for years to come. Really just the way the world is heading towards the green and renewables energy field, TransAlta is a no-brainer for growth, as well as that monthly dividend just under 4.5% really is just the cherry on top. It's going to offer you monthly passive income while you can see your investment grow over time in the long term. This is a no-brainer for any portfolio. So there you have it. Those are my two Canadian picks for monthly dividend stocks. Just a quick recap. They were SmartCentres, SRU-UN, which is a real estate investment trust, a REIT, which offers a 7.5% dividend. And the second pick is TransAlta Renewables, ticker symbol RNW. This one offers a 4.5% dividend, and we'll see some extreme growth in the future. Let me know down below in the comments whether or not you want to see more growth stock videos or more dividend stock videos or a variety mix of the both. Just let me know down below and I'll focus on making videos that you guys enjoy. I hope you guys enjoyed this video. If you did, please smash that like button and subscribe to the channel to follow along with my journey as I go from a $1,000 portfolio up to $100,000. Thanks, and I'll see you in the next one.